AI capital spending is pulling growth, inflation, and liquidity in the same direction, while rates and oil keep pushing back. You are watching vTalkInsight, Allocator's lens daily for June 3rd, 2026, where we connect these forces across assets in real time. In equities, the core story remains an AI-fueled earnings boom, keeping indices near all-time highs, even as inflation and yields stay uncomfortable. For multi-asset allocators, that means the equity book is still doing the heavy lifting on returns, but with increasingly concentrated sources of risk. Forward S&P earnings growth has jumped close to 29%, a pace we usually only see after deep recessions. Recent quarterly earnings beat expectations by a wide margin, and guidance for 2026 and 2027 has been revised higher, so price gains are largely tracking profits rather than just multiple expansion. Despite record price levels, 12-month forward price to earning for the S&P has edged lower since the start of the year and sits under roughly 22 times. That combination of strong earnings delivery and contained multiples underpins the constructive consensus and helps explain why realized equity volatility, as signaled by a mid-teens volatility index, remains relatively subdued. The flip side is leadership that is extraordinarily narrow. The rally is dominated by AI hardware, cloud, and a small group of software names in the US, Korea, Taiwan, and parts of China. In emerging markets, index performance is positive only because of a few AI-linked stocks, such as major Korean and Taiwanese chipmakers. Excluding them, returns are negative year-to-date. Momentum strategies and quant models are reinforcing that narrow leadership. Retail flows, hedge funds, and multi-strategy platforms are increasingly forced buyers of the stocks that have already rallied, and leverage is elevated with high correlations across positions. That reduces true diversification and leaves the equity complex more vulnerable if the AI narrative or rates backdrop wobbles. At the same time, the equity primary market is reopening in size. Alphabet is planning an $80 billion equity raise, its first in nearly 2 decades, to fund massive AI infrastructure, while SpaceX, Anthropic, and OpenAI are preparing mega listings. Over $100 billion could be absorbed in a very short window, which supports the idea of strong risk appetite, but also forces a reallocation of capital across sectors and regions. The tension for equities is that the same AI build-out driving earnings is also generating cost and inflation pressures. Memory prices are reportedly up more than 60% quarter-on-quarter. Enterprise hardware costs are rising faster than IT budgets, and electricity and software costs are climbing. Combine that with the risk of the US 10-year drifting toward 5%, and the scope for further multiple expansion looks limited even if earnings keep growing. Looking ahead, the key watch points are breadth, the IPO calendar, and long end yields. Any broadening of leadership beyond a small AI cohort would improve the perceived durability of the rally. Conversely, a spike in yields or a disappointment in AI Capex payback timelines could turn today's earnings strength and positioning crowding into a catalyst for a sharper equity consolidation, making the link to rates especially important. Turning to rates, the dominant theme is higher for longer. The Federal Reserve is increasingly portrayed as locked into its current stance, with policymakers more worried that policy is not restrictive enough than about growth being too weak. Headline inflation has eased from earlier peaks, but recent readings around 3.8% and stalled progress in non-housing services keep the Fed focused on price stability. On top of that, AI infrastructure is pushing up electricity, hardware, and software costs, while tight oil markets risk feeding through into headline indices later this year. Structural forces also matter. Repeated supply shocks, from energy to supply chains, have kept bond yields from settling into a new low regime, and some now see long-term yields staying structurally higher. If the US 10-year were to break above 5%, many portfolio managers indicate they would need to reassess equity valuations and risk budgets. Globally, divergence is widening. Eurozone inflation just pushed above 3%, reinforcing expectations of further tightening there, while the Bank of Japan is seen as behind the curve and likely to hike once or twice. That is encouraging some allocators to move toward more global fixed income exposures, with emerging markets shifting from satellite to core positions as policy paths disperse. In this environment, Some fixed income portfolios are combining duration with inflation break-evens to hedge multiple macro scenarios. U.S. bonds are increasingly viewed as relatively attractive as consumer and growth risks accumulate, even as inflation risk lingers. The balance between those forces in coming months will be critical not just for bonds, but for how sustainable equity and credit valuations prove to be. Credit still looks robust at the headline level, but the details tell a more nuanced story. Capital is flowing easily into AI-linked infrastructure, with strong demand for hyperscaler bond offerings and data center financing. Yet investors are being urged to scrutinize lease terms and legal guarantees closely. Alphabet's decision to raise $80 billion in equity, despite large cash reserves, underlines that even top-tier credits may prefer equity over additional debt for this Capex wave. More broadly, several tech firms are reported to be struggling to raise sufficient capital in traditional debt markets, turning instead to public equity and listings to fund large projects. Private credit remains a key valve in the system. Significant inflows and undeployed capital have kept pricing tight and prevented obvious stress from geopolitical and inflation shocks. However, competition for deals is intensifying, and some managers are moving down the quality spectrum, suggesting wider dispersion of outcomes ahead. Well-structured private loans with senior secured positions and moderate leverage are cited as capable of delivering double-digit yields with meaningful downside protection, but that rests heavily on underwriting discipline. For allocators, the message is that headline spread levels understate the true risk distribution across credit segments, especially around AI infrastructure and lower-quality private deals. In foreign exchange, the story is less about dramatic moves today and more about evolving fault lines. Policy divergence is widening as the Fed holds. The European Central Bank leans hawkish on upside inflation surprises, and the Bank of Japan edges toward belated tightening. The yen remains a key swing factor, with any sign of a more decisive shift from the Bank of Japan likely to reverberate through carry trades and regional risk assets. Emerging market currencies are increasingly influenced by both yield gaps and their exposure to AI supply chains, particularly in countries like Korea and Taiwan that have become central to the semiconductor ecosystem. Regulators are also reporting a surge in retail participation across derivatives, crypto, and even prediction markets. Authorities are expanding their toolkits, including AI-based surveillance and new rulemaking, which adds another layer of uncertainty to leverage currency and digital asset strategies over the medium term. Commodities, and oil in particular, remain a macro wild card. Negotiations around the Strait of Hormuz and broader Middle East conflicts are oscillating between hopes for an interim deal and renewed tensions, with shipping disruptions and elevated insurance costs keeping a risk premium embedded in crude prices. U.S. diesel inventories are at their lowest levels since the early 2000s, and ongoing Gulf shipping bottlenecks are reducing crude and refined product flows. At the same time, global demand is not firing on all cylinders. Chinese gasoline sales and crude imports are sharply lower year-on-year, which is helping cap the upside. Scenario analysis is therefore crucial. If a credible agreement reopens the strait in the coming months, some forecasts see Brent drifting down toward $80 and potentially to $70 as supply normalizes. Yet even under that more benign path, low inventories and infrastructure damage suggest prices could remain above $80 on average through year-end. For cross-asset portfolios, the key point is how energy prices feed back into inflation and the rates narrative. Each additional month of elevated crude and refined product prices shifts inflation forecasts and bond yield expectations higher, complicating central bank reaction functions and, by extension, discount rates for risk assets. Gold continues to feature as a strategic diversifier in this backdrop. It was one of the stronger performing assets last year, and some long-term projections now place potential prices in the 5,500 to 6,000 range by January 1st, 2027. Without taking a view on those precise numbers, the combination of geopolitical risk, higher real rate uncertainty, and heavy AI-related Capex keeps the case for resilient diversifiers firmly on the radar. Stepping back, the cross-asset picture is being shaped by a powerful but narrow AI earnings engine. A rates market converging on higher for longer, credit conditions that are loose on the surface but more fragile underneath, currencies reacting to widening policy gaps, and commodities that keep re-injecting inflation uncertainty through energy. For allocators, the main tensions to watch are clear. Can AI-driven profit growth and capital spending offset the drag from structurally higher yields in tech and energy inflation? Will the coming wave of mega equity deals and private credit deployment reprice liquidity or just confirm robust risk appetite? And how quickly do Middle East negotiations, diesel inventories, and central bank meetings resolve some of today's two-way risks? This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.